Which one? You talking about the bot? The bot's pretty good looking. I'm not.
Yeah, the guy with the real short hair has got real long hair now.
Yeah, yeah, you're looking bushy, looking bushy. So, want to wait 2 minutes to get started, or you want to jump into it?
Well, you can start talking. I mean, again, we're here, we're recording. You can do a little bit. We can always go back, but it's up to you. You're in charge. I'm just the commentator.
Are you here for the popcorn?
I'm here for
Give
the
me one
popcorn and
second.
the M&Ms.
All right. So today's webinar is about trading automation. The synergy of human ingenuity and automated precision. I got to tell you that that's what ChatGPT came up with. I actually like human ingenuity and automated precision. I thought that was pretty cool. So what we're going to talk about today is just the current state of the markets and how the trading automation is playing into it. We'll do a quick brief history of the market so we understand kind of how we've gotten to where we are today, and then how what we're doing plays in that market space, with the intent being to profitability. So, quick disclaimer: this is education and software purposes. We are not managing your finances. We're not a software company. That goes for Nova. That goes for TargetTrading.co, BubbaTrading.com. It goes for all of our companies. We are not financial advisors. We don't give financial advice. We recommend that you speak to one. I was on the phone with one yesterday, who was reviewing our hedging software and was amazed by it. So, uh, as we said, we're not financial advisors. This is for education purposes and for software purposes. So, who's Bubba? So long time trading veteran, about 3 decades on the floor. You're 47 plus years at this point, correct?
Yeah. 48,
Legendary.
48th year coming up, big boy.
Yeah, yeah. Legendary TV and radio personality. You can catch him on Fox News. You can catch him on VSiN. You can catch him on RFD TV. You're on a bunch of different stuff all the time. You've developed multiple option strategies and automation platforms over the years, and you're about 15 years teaching now, or you're going on 16, correct?
Going on 16 years teaching is correct.
So, and I think one of the things I like to stress here is a lot of the strategies that you've come up with, you've had to adapt and evolve over time as the markets themselves change. And as someone with your level of experience has gotten to see that, you've gotten to see the changes, how things work, how things change, and and the adjustments that had to be made along the way. And I think to me, that's a huge factor with it.
Well, I think you're right.
Me,
It's all about, that's why the classes are unique because I'm not teaching a standard. I'm teaching to what the market is doing right now.
And I think that's also why, we talk about the automation software, but I personally think that if you're buying automation software, you're looking at automation software, you really have to consider uh, what what you know about what you're buying. Do you know enough to make an informed decision? Do you know enough about the marketplace? Do you understand what's going on? And if not, you should definitely be getting you should definitely be getting educated. That's a big factor. And as the markets shift, the education is what makes you able to adapt and evolve as you go. Uh, this is me, 25 years in the financial industry, former 26 now, former investment banker, one of the largest institutions in the world, founder, owner, operator of multiple trading, education, and software companies. And I like to use the old Hair Club for Men quote: I'm not only the president, I'm also a client. I use our software, I use our programs. Deeply involved in what we do. When things work, I get to win alongside you guys, and when things don't, I take the loss. So I'm as incentivized as anybody to make sure things go the right way. And Bubba, you're the same way with that. We deep dive into what we do.
Listen, I wouldn't, if I wasn't willing to use it, I wouldn't put it out.
Exactly, exactly. So brief history here, guys. Start of the New York Stock Exchange, things were conducted face-to-face interactions. Through the 1920s, there was telephone trading. 60s, telex was brought in. Early 70s, NASDAQ was introduced in the electronic trading model. 1980s, 1990s, the digital networks at ECN expanded. This was when people started, at least institution levels, started electronic trading. In the 90s, there was an outbreak. I think that's a great word for it. There was an outbreak of online brokerages that allowed retail traders to trade as well. It wasn't just institutions. That made a big difference. Being that you had new players in the market, particularly inexperienced players who especially in those early days, they were getting ripped on. And 1990s, you saw the hedge funds start to employ quantitative algorithms and computer-based trading, automated trading. 2000s, you had the emergence of the Flash Boys, the HFT institutional trading. This was really who had the fastest machines, who had the fastest access. Uh, Massive electronic trading regulation ensued. And then in the 2010s, you had a lot of the retail traders continuing to grow and expand, realizing that they could do a lot of things for themselves, competing with the institutions, particularly as software became more readily accessible. People could mimic what the institutions were doing. And then the late 2010s, you had the crypto, you had NFTs, you had all kinds of crazy electronic trading concepts and instruments that never existed before coming to the market. Early 2020s, historically institutional level indicators are now available to the masses. This was an incredible shift in electronic trading because now the same software, the same modeling that a multi-billion dollar fund is using, you as the at-home retail institutional investor have access to. And then, by the way, that includes auto trading software. Recently, there's been some pretty interesting advents. We're seeing AI being used on a regular basis. We, in fact, use AI for a lot of our software, not to develop it, but to help us test it and to help us continue to adapt and evolve to ideal conditions. Real-time data analysis has become a huge factor, and there's a general decentralization. And it's funny because that decentralization is actually almost causing problems. I'm thinking of like NinjaTrader being purchased by Kraken and things like that. You're seeing, major crypto companies buying into more traditional market spaces to get access. There's a massive disruption going on. And I feel like that's a lot of that is evidencing what we're seeing in the markets right now. Um, Real quick background on Bubba Trading. It is a conglomerate of expert traders led by Mr. Todd Bubba Horwitz on with us now. And I think when people say trading experts, I have to put a big asterisk on this one because you see these guys on Facebook, you see them on YouTube, you see them on Discord groups. They hold themselves out as trading experts. And, you know, the strong majority of these people have, and I'm not saying all of them, but the strong majority of these people have never traded professionally. They learned how to trade online. They've traded online for 4 or 5 years, and they hold themselves as an expert. They want to sell you a course. They want to sell you their software. They don't really understand what's going on. They've never seen the variety in market conditions that a true expert has seen. And then I look at what we have and I see, Bubba, 47 years of experience. You watched the markets become electronic. I think of Pat, who was, early stage electronic trading up through what we have now. Seeing the emergence of overnight markets and all these other factors that have become, that have come into play. You guys have seen extremely high volume, you've seen flat volume, you've seen volatility, you've seen recessions, you've seen, you've seen it all. So when you have that level of true trading experience and expertise, you have a very different understanding of what's needed to survive in it. So when I say trading expert, I don't throw that word around very lightly. I think it's very important to understand the difference. And then we have developer experts. And I think these two together are what differentiates what we do from a lot of other companies. When I talk about developer experts, what do I mean? Um, I don't mean someone that just knows how to develop software. There's a lot of those guys out there. You can go on Fiverr and get them for a nickel. But the fact that we have very experienced traders who are also developers, that's where the rubber hits the road. That's where you've got guys that are able to understand not just what needs to be built out, but why and how it has to adapt and evolve in the marketplace. You can identify weaknesses in the system configuration, help make sense of it. You get more consistency, security, efficiency. I could go down all the little lingo of what we do with it, but the real thing to understand here is these top two, trading experts and developer experts, and they're working together. What we've really worked on is bringing a lot of key people on board with legal, with compliance, with onboarding, with support, with our general infrastructure, to make sure that if people do business with us, that they walk away from that business feeling that they got all that they paid for and way more. So that's our mindset with it. So let's jump into this, Bubba. You were talking a little bit in the pregame, and one of the things you were talking about is what's happening in the markets right now. We're in a pretty unique space. You want to kind of give a 30,000 foot view of what we're in right now, what's going on, and why it's so important to talk about it?
Well, I mean, the markets right now are relatively illiquid. I mean, you have high volatility, you have very low volume, you have very little participation, which takes away the price action. So if you're trying to day trade, it's very tough to be a very active day trader right now because there isn't enough action. I mean, even in our day trading we do every morning, the Market Mavericks, we've made 5 trades in the last 10 trading days. And we took off today and tomorrow because there's nothing doing. We're going to come back and trade Friday and hope that the news will bring some news. But right now, it's an overall lack of participation in markets, which is why we build longer term positions that can withstand through this lack of liquidity in the markets and the lack of activity, because it makes it without volume, without whip, without movement, it's hard to make any real money in the market.
Well, and it's interesting that that's what we're seeing now because it wasn't 60 days ago that we were living through the tail end of that crazy March and April where we were seeing massive fluctuations in the market, massive volatility, the tariff announcements and just, 30-point drops, double digit percentages getting ripped off on a daily basis, in both directions, So it's very interesting to see that we go through these really rapid movement periods, and then we get back into these periods where it kind of tucks away and it sits, and the volume just isn't there. But you've been talking about this volume problem for a while now. I seem
Yeah,
to
I
remember
mean,
you.
you have right now you have a lack of participation in the overall markets. Again, listen, let's look at the economy from an economy standpoint. The economy is not very good at the moment. Okay, it has not been good for years, and right now it's a little bit worse. So it does take away some of the action. But we're also in a market that's been pretty much consolidating, other than the whip, which we saw what we call in the business a V shape. Okay, we went straight down and came straight back up. But right now, and for quite a while, the volume has dried up, and we're looking for more participation in the markets, which is why we develop a lot of things we do that we can withhold and stand through some of these tougher times that for active traders, this is virtually almost an impossible market to be very active in.
Right. And I think the key is you've got to be able to handle both the volatility and the lack of volume simultaneously. Because not that they're both happening at the same time, but you have to be prepared, be able to trade within both of those environments. And if you're not, we saw it with a lot of the day trading software that the movements through a lot of the indicators askew, but the lack of volume made it very difficult to get in and out of trades without massive slippage. So it's a very difficult kind of balance to keep between the two. And as we talk about the auto trading software, and I think this is where it's really important, is you've got to be able to trade in a way that you're not exposed if there are massive movements or a significant lack of volume in either direction. Is that a fair statement to make?
No, you get we call it the vacuum effect. You get these dramatic moves in either direction, and again, they move just too far because there's nobody in the way. When they eliminated my job as a market maker, as a floor trader, that took away and allowed for more of these vacuum type of effect trades where you get these big moves out of nowhere. And typically, if you have a position, it can take you out and then go the exact direction you want it to. But because of the lack of action and the lack of liquidity and the lack of volume, it makes it much better to sometimes we talk about observing the market as making a trade as well. It's just watching because of the phase of the markets they're in right now.
Gotcha. Gotcha. And is this something, I mean, I'm not asking you to forecast right now, but is this something you see being a longer term trend where um, we're going to see this lack of volume as more of a regular thing, or you just think it's temporary because of the current economy and things?
Well, I think that, we go through phases of the market. The market go through three basic phases, and the most common and longest lasting is consolidation, which is about 65% of the time. The one issue I can say now is because we are going into summer, okay, we might expect a little bit less volume because summer is typically a little bit slower. However, over the last few years, markets have changed a little bit. We've seen a little bit more business in summer, and we're more traders are more focused on news announcements or tweets right now than they have been in the past. So you see the market sit and then they make a big move. And again, that makes it more of a challenge. You need to have what we call two-way markets where there's buyers and sellers that are fighting each other to take control versus sitting here and doing nothing, and then suddenly the markets will make a move. Does that make sense?
Absolutely. Absolutely. So, I mean, I know we talked about this last summer, that you were already seeing a year-over-year discount in volume. So is that generally the trend? And the other thing too, and especially in the futures markets, I mean, we're seeing things shifting to more open markets. Did I see somewhere that they were talking about a 24/7, a 24-hour market um for equities? Did I
All the
see?
markets are going to be 24/7 within, I predict within a year. Okay.
Wow, that short of a timetable.
Well, you already got 24/5 in many markets now. Okay.
Right.
So again, let's look at it from the exchange side. The exchange side, they don't need any more help to monitor because everything's electronic. Okay. So it's not like they need help to monitor. And of course, you've got Bitcoin right now that trades 24 hours a day. The currencies, although they don't trade on the mercantile exchange 24 hours a day, but they do trade 24 hours a day. So a lot of markets are already trading 24 hours a day. So all they're doing now is they're going to incorporate the futures markets, which basically trade 24 hours a day, the options markets, and the equity markets. So in my opinion, within the year, okay, the next 12 months, every market will be 24/7.
And that's gonna affect volume as well because it's gonna spread that volume out over the course of the day. I mean, I believe that it's gonna spread that volume out even more. So we're gonna
Well,
see
actually,
even
it will probably bring in more volume, and that's the interesting dichotomy you have here is that now if you open up the markets to 24/7, it brings in people from overseas that are normally sleeping. Okay, the markets aren't open when they're awake. Okay, so now they
right.
have open markets. So now, if you can create more action and bring in more participants globally, okay, now you can bring back more business in the market because that gives people more of a reason to trade because now the
Interesting.
markets are open 24 hours a day.
Very interesting. Very interesting. All right, I like that. I like that. Okay. So let's talk a little bit about how the products that you have, because you've worked on developing some certain things to be able to trade regardless of market conditions. And one of the ones that I absolutely love, and this has become, for lack of a better term, a passion project, is Ratio Trader. What exactly does Ratio Trader trade, and how does it trade?
Well, it's a long story, but it's a short story, and it's a. I've always been a big believer, and I've traded that way when I was on the trading floor, is to be able to control the underlying security or the underlying future and build a position around it that basically has a direct lean in one direction or the other. But if you get a big enough move in either direction, you can make money on that trade. And the beautiful thing about the ratio trader is if the trade is going against you, you continue to bank dollars on your option side of the trade, waiting for the futures or the equity side to do what you need it to do. And so far, we have not closed a losing trade yet here. But again, it takes capital, takes money to hold on to these trades. But at the end of the day, because of the way it's designed to be slightly bearish or slightly bullish, but as it goes in a direction, it gains the momentum of that side, and they can be very big winners. In fact, you referenced those wild days in March. Well, we happen to have been short the NASDAQ futures and long NASDAQ calls, and 2 Mondays in a row, the NASDAQ was down limit, which took us out because we can, even though the markets aren't open 24 hours a day, we can work our futures orders and positions 24 hours a day to take our profits even when we're asleep.
Right. Right. And I think there's two things you said that I think were really, really important. I just want to stress them. It essentially allows you to operate as long as the market moves. It just can't be static. And right now, when we see this type of volatility, it allows us to participate in either direction. But I think the other side of that with it is you have with ratio trader, you have the ability, because it's being done with futures and futures options, you have the ability to close those trades after market, which I got to tell you, I've been looking at some of the things that have been happening when the news is coming out after four. You're in a long position, and something comes out in the news that it's terrible. We're not making a deal with China, and the gap open on Monday is so ridiculous. The angle is so ridiculous you can't even get into the trade. Well, if you're futures trading, you're able to move that trade over the weekend, and it's very, very powerful to be able to do that. So I think that's two really important points. And there's a third one actually, which is, and I have to clarify this because I think it's so important what you said. We have not had a losing trade on Ratio Trader. We haven't had a single losing trade since it opened in February of this year, has not taken a single losing trade. However, it does require capital to buy those rolls as it moves. So as it's rolling, there is a play, but when the trade is closed out, it has not lost a single trade. So I think that's a really important distinguishment to make. It's not something that you would do with a small account. You want to do this with
No,
with
you have to have enough capital to hold on to the position because we've been trading it, although we put it out, we've been trading on the Saturday call for about 8 months now and have not closed out a losing trade there either. But again, you have to have enough capital to go through the dull market conditions where the options decay and you get no movement. And of course, when they go against you, where you're collecting credit, but eventually, we all know that everything will eventually revert back to the mean, which if they go too far away, that's all we need is a mean reversion and we get all our money back and make a profit.
Right. Right. And that's what you've been able to do consistently, literally with every trade in there. The thing that blows my mind is there hasn't been a single losing trade. There's times when we've had to sit in the trades and you sit for, a week, 2 weeks, 3 weeks, but you've never actually had a losing trade there, which is just such an incredible statement. And I think one of the other powerful things with this is it doesn't require a lot of volume because it's not quote day trading. The volume really doesn't matter. It's more about the volatility. So if there's not a lot of participation, it's okay. You're still able to get out of the trades because they get out kind of over time. And I think that's a real big asset with Ratio Trader and why it's such an awesome software for this market, for these markets. I think that's a big explanation point. Um, where does it trade? It trades futures. It trades futures and futures options. We right now offer it, and I'm actually going to get down to that um, about how we can use it. But just before I get to that, minimum investment 15 to 20,000, you'd say?
20,000, I would say. I mean, 15's okay, but I would say 20. Again,
Right.
I think, we actually had, just full disclosure, we had a couple of people that did lose money because they didn't have enough capital or didn't want to keep the capital in
Stay in the trade.
to stay in the
Right.
trade. So eventually every trade turned out to be a winner. And again, there isn't an abundance of risk, but you have a margin requirements on the future side and you have cash requirements on the option side. So it takes capital because the key is you have to be able to hold on. Okay.
Right.
And if you can hold on, then there's never an issue. Okay. It's always gonna make money as long as you have enough capital to hold on to it.
Just to stay in it.
It's very
Who's the
similar
sport?
to equities. I mean, equities have gone up 8.5% year over year for history. Okay.
Right.
And again, it always comes down to, do you panic? Do you puke it out? Do you not take the pressure? And the losses never get to be that big. But again, it's the holding cost of margin requirements, and that's the deal. And so if you have enough capital, then you should never panic when it comes to money or trading. I mean, that's the biggest problem for for most people who fail.
Right. Right. And would you say there's a maximum investment with this? You said about 20,000 for minimum. Is there a maximum? Can you put 200 grand, 500 grand? Is there any
I have more.
maximum to this?
I have more than that in it. So yeah, you put as much as you
Yeah.
want. I
Yeah.
mean,
And
the
that's
more
one
you
of
put
the,
in, the more you put in, the more trades that you're able to benefit from. Okay, the more you can do, the bigger the size. Again, there's a lot of advantages to it. Again, we believe in organic growth. Start with X and continue to grow it, and then you grow your position sizing at the same time, or the products that you can trade. Because I understand how to make certain trades work using different combinations, and I think that's important. Not everybody else can figure that out the way that it works, but we can create. We put on a trade this morning. We put on gold this morning. We sold August gold because it's going to roll next week. We sold August gold at 33.48 or 33.44. I don't remember the exact number, but it doesn't matter. And we bought the options. But in that case, the micro gold does not have options on it that are liquid. So we did six micro options and we bought one call, which is 6 by 10 or 5 by 3, which is the ratio that we use.
and I'm sorry, I was just thinking about how you said that. I think you hit on something too. Because it's futures, the margin is different. You don't have pattern day trader rule issues. You can actually
There's no day
trade with.
trading rule, and of course the margin will change when the brokerage firms get nervous. They raise the margin a little bit, but typically a mini S&P is about $1,100, and we're usually carrying three, so that's $3,300 in margin there, and then the cost of the options, which depends on which option we're buying and where we are. But again, the beautiful thing about the no day trading, no pattern day trading rule, margins are much lower, no reg T, so that you don't tie your money up. Once you close a position, the cash comes right back in your account. So many benefits to using the future side, plus better taxing as well.
Yes, no, no, absolutely on the tax side, but I think the margin is huge because you can do it with less money. Even though you still need 20,000 in there, you can do it with significantly less. I mean, that same trade in a traditional SEC format would be 75, $100,000 just to be able to sit
Well,
in it.
no, it would
So
be. I mean, the same trading comparison would be 180,000 on the underlying plus the cost of the options. Okay.
right,
So again, it's a lot better to have to put up. So if even if you get 50% margin, so you'd have to put up 90,000 versus putting
90,000,
up
yeah.
3,300.
Right. So it's huge. It's yeah, it's awesome being able to do it on the future side. We do have a couple different ways we use it. I know you had mentioned the Saturday and Monday call. And we also have what's called a letter of direction program, which is essentially traded for you. That when we talk about automation, that's full automation. That's through CTG. It's our partners over at Capital Trading Group. They are licensed to trade it full auto. And basically, it goes in your account and they take the trades for you. You're able to see the trades each day as they come out. And it does follow the exact format. And then on Saturday and Monday call, you're doing education on this. You're actually teaching people how to do this for themselves and what to do with it, correct? I mean,
Yeah,
walk me
no, I
through that.
teach how to do it and I help manage it. And again, I go through the process, and there's a couple of different quirks that we teach and know how to use, but it's all under the same compass of using the derivatives against one another to create a position. And it's create a position based on what you expect the market to do, but knowing that if you're dead wrong, you can still make money on the other side. So that's the beautiful thing about this trade.
That's the real power in it. Yeah. There's a core account for this, right? You've got a main account that basically is used as the main traded account at CTG.
Yeah.
What's that up right now? So if you took every trade and you stayed in
Every
every
trade
trade.
right now, every closed trade right now at CTG is up 31%
Wow, that's awesome. So and that's since like early
since
February,
February.
I think
Since
it was.
February.
Yeah, so that's awesome. Very cool. All right, so that's ratio trader. I personally, to me, this is like the uh what's the term? The cup. I don't know why I can't think of it. This is the silver bullet. This is the what's the cup that they had? Come on, Indiana Jones.
This is the Holy Grail.
Holy Grail. That's what I was
Indiana
looking
Jones.
for.
This is actually in real factual honesty. This is what traded my entire life on the trading floor. This is what I've everybody, anybody here who knows me knows. I always said, I got to figure out a way to help you trade the underlying security as part of a trade because that gives you all the power when you control the underlying. And I got to just give a quick shout out to my friends in Switzerland that are here today. What's up,
Oh,
guys?
very cool.
Anyways,
Very cool.
again, being able to control the underlying is a very key part of trading, and that's what we're doing. We're controlling the underlying.
So and as I said, the holy grail, the silver bullet, whatever you want to call it, to me, this is one of the most incredible trades. And watching it happen in real life is really cool. It's like a loading up a spring, and then you see it take that big, rip your face off rally, and it's just awesome. So it's a very fun trade to watch. Let's talk a little bit about equity portfolio management because I think that's another one that's real interesting in this particular trading environment. What does it trade and how does it trade?
It trades a series of equities, Apple, Amazon, Google included, Tesla,
You're buying
and
the equities?
we're creating synthetic stock.
Okay.
Okay. So the margin requirement for the big portfolio is 25,000, which gives you basically three times the margin, so you're never in a margin problem. It trades every week and it will roll up and down during the week depending on the which way the markets are going. And it will help you capitalize on some profits. But I think the biggest thing that is it is profitable for the year, but the real key is right now we don't have a position on in that in the equity portfolio model. We are flat the markets 100% right now.
Why is that?
Well, everything has reached its level of where we wanted to get out that we had on. We were long when everybody said you can't be long. We were long, and of course we saw the big rally, and we were able to get out of everything, and nothing has triggered. And with the lack of participation, the lack of movement in the markets right now, we have not triggered new signals yet, and we're not gonna. We don't force trades, Michael. We don't force action because we want to be in the markets. Sometimes it's better to be on the sidelines, and right now there is no new signals for me to give out, and I'm not going to try to guess and force the system to make trades. We're flat. We're profitable. We came from up to down a little bit to profitable, and now right now we're flat, waiting for the next signals to come. And until they come, we'll be on the sidelines.
I love that you can be out. I think that's such an important concept in this is that you can actually sit on the sidelines and wait until there's opportunities. When it's in, what would it actually look like if it was, for lack of a better term, all in? How many trades could you be in? How many markets can you be in?
I mean, we could be in as many as 15 different markets at one time if everything's set up right. Normally, I would say we're in 7 to 8 trades at a max, but there has been times. I mean, we were at one point long everything at the from the bottom of the market there. So again, it's hard to say. It really depends on action. But if you're going to ask me for an average, I would say we'd be in 7 to 8 positions at a time.
7, 8 positions and generally long, or it's
No,
also taking
it's
short
always
positions.
long, but sometimes you want it to go down, right? Your long puts or your long calls, right? That's if you're creating a synthetic, your long stock. If you own the calls, if the put is the key that denominator, then you're short the market, but you're still long the put, right? So people get confused. So you'd be long options. It's the question of which side. You're creating either a synthetic long to create ownership of the stock or a synthetic short to create a short position in that stock. Okay. So you can be on either side of the market. We don't pick a side. I would say to you now, based on the overall market and the rally that we've seen, my guess is that the next trades that will come out when they come will be to the short side of the market because we are very overextended to the long side right now.
Gotcha. And it's basically waiting for those indicators to identify a downward market movement before it comes back in.
Right.
Got it. Got it. I know you talked about the minimum investment, and didn't you just recently consolidated some of the different platforms? So it's now essentially one core platform. Is that how you did it?
Well, we've got actually two. We've got a one that's a $25,000 investment and one that's an $8,000 investment, so that with smaller accounts can participate. And it trades the smaller one trades about 10 equities, and they're a little bit smaller. Some of them are the same; they cross over from one portfolio to another. But there are some others, and again, it's to allow everybody to participate because really, I don't really care about what the symbol. I only care does it make money or not.
Right. Well, you've said it to me before. At the end of the day, show me a chart for, and it can be anything. All the charts look alike. They're
All
all
the
the same
charts are
pattern.
the same and all the patterns repeat themselves. That's a fact. That's not my opinion. That's fact.
Yeah, I remember you saying that to me. It's this that one stuck with me. So, and you said there's an 8,000, and what was the other one? I'm sorry, 25,000.
25.
All right, and you can have multipliers of those, so I can go in
Oh
and
yeah,
have
no,
10.
listen, we have people that trade 10 times, right? Ten contracts per thing. Okay. And again, it's you have to, my opinion for everybody is you always start at the smallest amount to start with because A, you have to get comfortable, you have to see it work, you have to feel it and understand how you're going to react when it goes against you because we know that drawdowns are a part of this business.
Right. Right. Absolutely. And you got to be able to sit in, and this is another one, you got to be able to sit in it. And then just to be clear, you used a term early on, and I want to just clarify it because I know it was a new term for me a couple of years ago, is this concept of synthetic equities. So you're not actually purchasing the underlying instrument, you're buying a synthetic equity in
Well,
this.
no,
Well,
yeah,
you
because
mentioned that.
I can create, for example, I can create a synthetic long stock in Apple for let's say $700. Okay, so I'm creating 100 shares of Apple for $700 versus if I just bought Apple outright, it would cost me 20,500. I can make that same position for about 700 bucks. Okay,
Right. Right.
so
So you're
that's to
getting
create. That's
leverage.
using derivatives against derivatives to create a synthetic model.
So you're getting the leverage of your buying power with that, if the market moves in the direction that you want it to. I mean, that's really the benefit.
Well, yeah, I mean, the synthetics are what market makers traded almost predominantly, me being one of them. And then what we started to do was using synthetics in the hedging, which I know you're going to talk about later, but for people who are trying to catch up on their RA, so you can trade, you can represent a big portfolio with little money.
Yeah, that's cool. That's really cool. All right, so we talked about it's synthetic equities. We talked about one thing I've noticed with equity portfolio. Me in particular had this. I had this. Can you talk a little bit about assignment and how that can happen and what that means?
Well, what happens is if an option gets too deep in the money, and typically it'll happen if we're on the wrong side, our short option we have a spread on, and the short option will get deep in the money, and you can get assigned, which means you'll take the stock. It does not increase the risk, but it does take up and suck up some of your capital. But we've actually solved that to avoid assignments because I have the power. If I can see that there's going to be assignments triggered, I can roll the trades early and take away that assignment. It's not really risk, but it does throw havoc into your capital because you were using $700 on Apple, but now you're getting a margin rate for 20,000 because you've got 100 shares of Apple on your account that'll have to be replaced. But certainly we have solved that problem as well. So that's not really an issue anymore.
And that also takes away the less manual need for this because when you would get like at least for me when I would get assignments, I would have to go in and
No, we would have to you would have to fix it yourself, and of course you'd
right.
have to make the adjustment in the software to tell it what you were doing. We've taken that away pretty much as a regular basis now because again we know that it's not an issue. It's a good thing. I mean, actually,
Yeah,
this
it's a good thing. You got assigned the stock. Yeah, that's a
well,
good
it's
thing.
a good thing because you want to control the underlying. So you're now controlling the underlying. Your risk is exactly the same. Your reward changes to be much higher if you get some kind of crazy move. But what it does do is for people that don't understand, it does create a little mental havoc and it does create some margin issues that we have to adjust. So what we did is we rewrote and gave me the ability to trigger a roll earlier so that we don't have to take the assignment, so we don't have to go into the mess and try to fix everything.
Sure. So just aiding in the automation, really more than anything,
Yes.
for the automation experience.
Yes.
So talking about automation, right now this is available. It's fully auto traded via Trade Your Brokerage. I'm a huge fan of Trade Your. Can't say enough good things about them. How would you describe Trade Your, Bubba? What would be your
I would
best?
describe it that it saves me $100,000 a year in commission.
I was hoping you'd say that. That's what
Well, I mean,
I was
listen.
throwing you a softball for that
You
one.
you realize on Friday, every Friday I trade somewhere north of 4,000 contracts. Okay,
So do the math.
so again, whatever your broker is charging you, I'm paying $10 a month. Okay, flat.
Flat.
Okay. And in the equity portfolio system, I have no cost of the system. I buy the equity program and I get the software for free. Okay. So again, it's costing me $10 a month, and I trade, like I said, I probably trade without trading, I'm going to trade 25,000 contracts a month just on positions that I have open.
Yeah, exactly. Exactly. It's just incredible. Jennifer, yes, this is actually how the hedging software works. That we're going to get into that in just a second. It's literally how the hedging software works. And it works under the same principle. So yeah, trade your $10 a month. It's really hard to beat that. I kind of laugh about it because I remember the first time I saw it and I was like, there's got to be hidden fees. There's got to be something here. And it's not. It's $10 a month. So very, 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 very cool program. Speak of the devil, let's talk about the hedging portfolio model.
Just a quick note. I haven't made a trade personally today, but my automation has traded 175 contracts so far in my hedging account.
Yeah. Yeah. So just on even on low end per transaction costs, that would be absurd. It would be absurd. So yeah, you're saving north of $100,000 a month.
Yes.
Well north of it. So I know Jennifer asked about it, a couple people have asked about it. We're talking about the hedging model. So the hedging model is something that I mean I've looked around for anything even close to this. You and I did that little sitting at Red Rock. We did that little experiment. Find something like this in the market, and there's just nothing like it. This is an extremely unique program. Talk to me a little bit exactly about the hedging program, and then I got to add a couple of screens here because I want to share some really good ones.
Well, I mean, the bottom line is that you buy insurance for your car, your health, your life. Why aren't you insuring your money? During the big collapse when we went down to the lows in March, all of our guys that were hedging were buying a lot of more stock. And look what happened. Now the markets have gone all the way back up again. This is a model that's automated, that's automated to your specifics. You make the specs. We tell you how to do it, and you can put whatever specs you want. We have standard that we use. But again, I go to the golf course on a Friday when all these rolls are happening. I don't have to pay attention. I just get an email and a text telling me this trade was taken care of and done in my account. Anybody who's not hedging, I think, is making one of the biggest mistakes in your trading career because that's the core. That's your core money. That's your money you're saving for retirement or for whatever you're saving for. You want that protected. But the one thing we can say with 100% certainty is that you can't time the market. It is time in the market. You've heard that 1,000 times. And I said this earlier. The stock market has gone up 8.5% year over year since the beginning of time, and 10% year over year since 1950. Okay, so if you had never sold out of your positions, you would have a lot more money right now than trying to navigate through the market. So the hedging model allows you to stay in because when the position is going against you, it's going to roll down and going to buy more stock at lower levels. And when it goes back up again, it's going to reestablish a new basis at a higher level. And there's nothing like this. And you can search for what we teach everywhere. I gave this proposition to Michael. I bet him 1,000. Okay, he couldn't find it, and he couldn't find it, so he paid me. Okay, at the end of the day, you won't find what I teach because most people don't understand it, and most people don't want to get involved with it because they don't really want to help the customer or the client. Okay, ask your advisor; they'll tell you you're nuts. And of course, I'm telling you that I've got every dime I have hedged because it does nothing but make money over time and keeps me in the market. I never have to think about what's going on in the market.
So, and the way our hedging program is configured, it's number one, it's configured in a customized fashion. So it can actually be configured to your portfolio. I think that's massive. You don't need to have a huge portfolio. One of the things you mentioned before that I really like is your IRA catch-up. And we just don't talk about this enough. Can you just talk a little bit through about what the IRA catch-up component is? Because to me that's just I've never heard of this before. I think it's incredible.
Well, what we do is we create synthetic stock, okay, and you're going to use some leverage. And typically, I have people start out at 2-to-1 leverage, but you're going to create some stock. You're going to create a portfolio, creating synthetic stock, which is kind of like the equity portfolio positions, okay, and then you're going to hedge those positions and you're going to get the benefit of being long the stock if the market goes against you. You're going to get the benefit of being hedged if it goes the other way. And at the end of the day, many of us are behind on our IRAs, and there's no way we're going to ever catch up unless we use this synthetic equity model to catch up and to create a little bit larger position in your portfolio. I had one guy that I used as an example the other day. He started with $8,000. His account is now 25,000 after about a year and a half. Okay, and I'm not saying everybody's going to do that well, but my point is that he created all synthetics. Okay, because he didn't have enough, but now he's tripled his IRA by using synthetic stock. And again, it's something that you can use. I use it because I like to use it, and I like to be more aggressive and create more positions. But it was designed and first built for people who are behind in their IRAs and need to catch up.
Right. So with that in mind, you could use it for IRAs, which is a huge benefit. I for growth purposes, you have the tax-free growth. I also like it because you don't need to start with some massive portfolio. I think one of the misnomers when people see hedging is they immediately think, well, I don't have a $1 million portfolio. I really don't need to hedge anything. And I think that's such the wrong mindset. And that's why I love that IRA catch-up. Which by the way, it works outside of IRAs too. But
No, it
but
works everywhere. I mean, I use it for IRAs because that's where people are going to be the most limited in money, and
right,
because you cannot add excess. You can't add more money to your IRA except once a year. Okay. So you have to grow that on top of everything else. And of course, the IRA is something that you're looking for. I use it. I don't use it in my IRA. I use it in my day-to-day trading. Okay. I mean, I've
right,
got right now in synthetic stock, I've got 3,000 shares of coin, 3,000 shares of Tesla, 2,000 shares of crowd that are just done as synthetics that I'm trading.
right,
Okay.
right.
Those are not in my IRA, but again, they could be.
Right. Right, exactly. So, where does it trade? We use it specifically at Trade Your again, but that comes down to the $10 a month. That to me is a no-brainer. Minimum investment, I mean, with the catch-up provisions and stuff, it's pretty small. I mean, you don't really have to have anything crazy in there. You just mentioned the guy that did it with 8,000 and had the catch-up component turned on.
Right.
If you're doing more traditional hedging, you would want more just because you wouldn't want to get stuck with any of the day trader rules. But for the IRA catch up, you're totally fine. Um, I don't think there's a maximum. Am I
No.
wrong? I
There's
don't think
there's
there's.
no maximum because the products that we're using to hedge with have plenty of liquidity. So, again, you're using the spiders, that you're using the busiest stocks on the exchange.
Right. Right. And it is custom. I think that's another thing we have to talk about. You actually, and I please don't use the student name, but can you talk about the recent plummet in
And UNH.
yeah, you want to walk that one through? That's a great story.
Well, I mean, if you look at the stock, the chart of UNH, you can see the stock dropped about $150. And one of our students had just recently signed up and had hedged it and it bought a lot more shares, and the stock has already started to bounce back. But again, it protects you from devastation. It allows you to stay in without panicking to get out. And it's a model that just allows you to stay in the market no matter what's going
Yeah.
on. You don't have to worry about it because all you're really doing is doing what you're supposed to be doing, which is buying or dollar cost averaging lower. But the dollars that you're using to buy are dollars that are being created by your hedge.
Yeah. Yeah. Well, I like his example because he had gotten stock options as an employee and would have been stuck in those positions with that massive drop if he hadn't been hedged and it saved him. It saved him hundreds of thousands of dollars. I mean, it was an incredible savings and he was brand new to it. It wasn't like he had it for years. I mean, it was
No, he had it
kind of
for
got it
probably two
on.
weeks.
Yeah, yeah, he literally got in and got his position set up and said, "Thank you for the safety net." But I think one of the, and again, I'm going to use this example again. I think one of the misnomers is we talk about it as a hedge. It's so much more than just a hedge. It's not just a safety net. It has an aggressive attacking component to it. I wanted to show that portfolio that you built out for me. Hold on a second here. Let me see if I can share this screen. And it's a screenshot, but this is since, are you able to see that?
I am, yes. I think everybody should because I'm looking at your presentation.
Good. You want to walk me through what what
I
what
mean, this
happened here?
portfolio we started, it's got, I'll tell you what the holdings are in it. Okay, hold on. It's got Apple, Amazon, GLD, Google, IWM, QQQ, SPY, and TLT. It was started, I believe, last November or September, somewhere. It was last year at the end of the year. Okay. We started it with $1,024,000 and 24,000. The portfolio is now worth $1.4 million. Okay, so it's up
Right.
40%, and of course that's because of some of the action in the market, and it continues to accumulate. The opening position in Apple, for example, was 500 shares. There's now 707 shares of Apple. The opening position in Amazon was 500. There's now 666. So again, it's accumulated a lot more shares, which every time it goes down and goes back up again, you're making a lot more money.
Yeah. Yeah. And I think that's really, and that's why I say it has an aggressive component to it that isn't, I don't think we talk about enough. You think of hedging and you think of defense, but I think in this case, it's important to understand that
Well,
the defense
I
is a good
think
offense.
what you're really looking to say is you are playing defense, but you're bringing in the compounding effect to the market. Okay, which is exactly what you want to do. I mean, Albert Einstein said that compound interest was the eighth wonder of the world, and you're compounding your portfolio because you're able to stay in that portfolio uh, no matter what's going on. When the markets are going down, just like with UNH, the markets went way down. Okay, in fact, I'm going to look it up right now while I'm talking because I'll give you exact numbers of where it went to and where it is now. UNH went down to $250. Okay, right now it's 307. And I know that this person bought a lot of shares somewhere down around 250, 260. Okay. And of course, now they're worth over 300. So again, you've gotten the balance. And of course, not only have we rolled down, but now we've brought up our protection price, and our basis now is, I'm going to guess this basis probably now is about 290 if it goes lower, which means if it goes below 290, you'll start buying more shares again with money that is created by the hedge that we put on. So it's aggressively buying, but only based on certain percentages and certain movement in the market.
Yeah. Mathematical certainty. I like that term. Um, So what's the best way to use it? I mean, we have it as the hedging software, as an independent platform. We do have some education with it. As I said earlier, we absolutely want you to be educated. It is fully operational on TradeYear. Again, we can't beat $10 a month. And then we also offer it as part of our COP program, which is the Comprehensive Options Program. It's a 10-week course that Bubba teaches everything about options from the absolute bare fundamentals to the more sophisticated
Yeah, we just
structures like
finished yesterday. We just finished the synthetic metals.
yep, yep, yeah. We just exactly. And I will say this is a great time to get into the COP program because it's a lifetime membership. And right now we're taking a little pause from the live teaching, so you get lifetime membership for literally it's a third the cost that it normally is right now. And you still get the lifetime membership, and you can still go to all the live classes and stuff. So while we're in this pause period, we're offering it a deep discount because your first access would be a lot of videos first before the live starts again. So that's really it's a great time to get involved. But you can get hedging access through both of those programs. The only difference is in the COP program, there's about 14 hours of education that goes with it. That not only explains it, but how to use it, but also all of the other aspects of options trading. This is another one of those programs where when somebody asked me, what's appropriate for me, like, and I said, there's certain things that everyone should have. If you're investing in any capacity, I feel like you should have this on your portfolio. I feel like this is something that you should have, whether you're in a growth mode or you're in a protection mode or both. This is like one of those, it's got to be a box you check. It's like buying car insurance. You wouldn't drive a car without car insurance. You wouldn't own a house without homeowners. This is right up there. Um, all right, let's grab. And the last one I want to talk about is SPY A. And lately we haven't been talking a lot about SPY A. What exactly is SPY A? What does it trade? And we'll talk a little about why we haven't really been talking about it as much lately.
Well, I
So
mean, we buy a call or put on Fridays, and we look to obviously we're looking for market direction, and we hadn't traded for about 4 or 5 weeks because the volatility was too high, the cost was too high, and it was too tough to trade. So we didn't want to give up that much of an edge. And one of the things that I'm always looking at is what edge do I have to give up to get in the market? And sometimes it's not worth the edge you have to give up because of the risk that you have to take. It's a nice little model for a small account that just wants to participate in the market. But again, I will make decisions just like I would for myself. If I'm not willing to trade it myself, I'm not putting anybody else in it. And if we don't have a true signal, now we have a true signal. We're actually long puts right now, which are somewhere near about break even for this week. They've been up and down. What's going on? But again, we really have no action. I mean, the markets are basically where they were on Friday at this time. But it's a nice, easy way to get involved if you want to try something with some automation that does it for you automatically. It buys calls or buys puts and takes closes your position on Friday, and it trades Friday to Friday with the opportunity, if you get a move in your favor, to roll up and capture some of that profit, yet by still staying in the market as well.
Yep. And I think you hit the nail on the head. This is a great way to kind of get your feet wet and see if auto trading is something for you because it's very manageable. You can close the trades yourself if you want to at any point. It kind of gets you used to the auto trading world. It also is a very low barrier to entry. You can get into this with $5,000, $3,500. You can start trading one contract and do just fine. Um, one thing I love about this is, and I know you and I we are very conscious of ever talking about results, but year over year over year, this has had just incredible results. But what's interesting is, and this is the caveat that I bring, is it always has drawdown periods. It has because it doesn't trade but for once a week it has these periods of drawdown. So it's a great way to learn to sit in the trade because sometimes you'll trade two, three, four losing weeks in a row and then have these massive winners. And it just forces you to continue to come back to the table, continue to take the trades. This has not had a losing year as long as I've seen it.
No,
And
it doesn't. But again, look, it's the same thing. There's an old trading term that we use on the floor called puke. Okay. If you have the wherewithal to sit in the trade and not puke it out and not get nervous when you go into a drawdown, because you're going to go into a drawdown. I mean, I don't listen. I've had plenty of drawdowns in my life. If you can't deal with them, then it's not going to work for you because that's the problem. People tend to, just like in markets in 08, they puked it out, and in 09 they came flying back, yeah, but they were all out, and many people are still
everybody
out
was
of the
sitting,
market.
everybody was sitting on the sidelines and they didn't
So
get that ride back up.
either you believe and you understand and you've gauged your risk, or you don't. Okay.
Right.
But if you're gonna try to micromanage what's going on with the news or with the market, then you have no chance to make money anyway. So this is the best thing for a newbie to start out with. It's a basic program. It's one or whatever how many quantity trading, but it's one trade that can make money during the week and roll up during the week and take profit off the table while still staying in the trade. But it's going to go through 3, 4, 5, 6 week losing streaks. It happens. It's part of it, but it has not had a losing year.
I think there's another play with this too that I don't think we talk about, which is if you're actively day trading, I think it's a great way to sort of leverage yourself and take trades that you wouldn't normally take. I think that to me that's a big play with it. We talk a lot about how we talk a lot about how we want to leverage our time, we want to leverage our effort, we want to leverage our trading capabilities, and this is a great way to do that. Um, the other, let me just see here real quick. Best way to use it. Now, I know we auto trade it at TradeYear, but one thing that we don't talk about with that is you also have a lot of people that take that trade themselves. So they take that signal and they execute that trade. That's correct?
The software, if you don't trade at Tradier, or if you live in Canada right now or other parts of the world, you don't have access to Tradier right now. Now, there's a good chance we're going to add, for those of you in the UK and Australia, we're going to add probably Tasty Trade for some of the automation. Um, but at the end of the day, you get an email in the morning, you get a text and an email when it's time to execute, and it tells you exactly what to do, exactly what to buy, and when to buy it.
That's awesome. That's awesome. So, just a reminder, this kind of dovetails into what you just said. Every software is not for every user. This is like a big thing, and I stress this so much. We had the disclaimer in the beginning. Don't trade with money that you can't afford
Can I say
to
one thing? Can I
lose.
interrupt you for 1 second?
Yes, sir.
Hedging is for everybody. It is the one product that is for every investor in the world, okay, is hedging. Because everybody's trying to build a longer term portfolio, 401k, IRA, whatever it is. Hedging is for everybody. Okay.
I could not. You literally took the words out of my mouth. That's that's where I was going with it. So every software is not for every user. Now there are some softwares that are for every user, and I would say out of everything that we have, that hedging software, you start it now, you let your portfolio grow. To me, that is just the absolute no-brainer out of everything that we've got. But some of the others, maybe you're not ready for ratio trader. Maybe you don't have the stomach for like the EPM model or for SPY. But hedging is absolutely a no-brainer. And I think that's a really important distinguishment to make. So let me talk real quick about important links. First of all, I want to say thank you guys for participating today. And what we're doing is anybody that if you saw anything today that caught your attention and you want to learn a little bit more about it, I would recommend doing a discovery call. You can go to targettrading.co /webinar, and you'll see a link there that you can click and you can schedule a discovery call. Any of the people that you would schedule with, they know what they're talking about, guys. We deal in with traders. Our entire staff are traders. Our employees are traders. We don't like having inexperienced people talking to our customers for the very simple reason that you guys, our goal is to educate you guys, and who are we if we're not educated ourselves? So schedule your discovery call, learn about the different programs, ask your questions. If any of them caught your interest, what I would love to give out right now is either 30% off or $500 off, whichever one gets you the best discount on any of the programs. And I will tell you, there's some great discounts already this month with Memorial Day. So this would be in addition to your Memorial Day discounts. So if there is something there that catches your eye, that interests you, please, please, please take a look. If there is if you've got questions, please reach out and do a discovery call. But in the meantime, if you'd like to ask some questions now, I'm going to open up the Q&A if that's all right with you, Bubba.
Fire one ready.
And I love what you say about the hedging, by the way. The thing that I think we sat on the hedging for so long and showed it to people as a way of protecting themselves that we don't stress enough that growth component. Oh, by the way, if you guys have any questions, drop them in the webinar chat or the Q&A. You'll see both of those links there. Um, but I don't think we talk about enough how awesome it is as a growth model. And the fact that that IRA catch-up concept is just awesome because very few people have correctly funded their IRA their whole lives, and you got to play catch-up on it. And the fact that you can do it in a tax tax beneficial way is huge. So I am not seeing any questions. So Bubba, you're good to go?
I'm good to go. Listen, again, it's important to get education. It's important to learn. It's important to understand how the markets function, how they work, and sometimes making a decision not to make a trade is okay too. Don't think you always have to be involved.
Yep. So thank you guys very much. And we're going to put up, you'll get an email with a link to this recording if you want to go back and watch it. You'll also get in that link some additional information and the opportunity to, again, schedule that discovery call. I strongly recommend taking the discovery call. Even if you've just got some baseline questions, let them walk you through it. There's a lot of other things that we do here, but really right now, this is a great market to be involved in the automated trading. So can't stress enough how important that is right now. Thank you all for your time.
Thanks,
You guys
everybody.
have a great day. Bubba, we'll talk soon.
Thanks, Michael.